Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to work a practice problem related to translation and journal entries in Excel. Get ready to account with Advanced Financial Accounting. Here we are in Excel. We have our information on the left-hand side. We're going to put that into our worksheets on the blue area in the right-hand side. So let's take a look at our data. We have on 11X0P, which is going to be the parent company, purchased all outstanding stock of S, which is going to be the subsidiary located in Canada. The cost is going to be $140,000, so $140,000, that's in dollars. And then on 11X0, direct exchange rate for Canadian dollar was 1 Canadian dollar is $0.8781. That's going to be our exchange rate as of 11X0. And then on 11X0, S book value was in Canadian dollars now, $94,000. So the book value, assets minus liabilities, equity section, as of the point in purchase, $94,000, but in Canadian dollars. Then the fair value of S plant and equipment was higher than the book value by $10,500, once again Canadian dollars. The depreciable life that we're gonna run that over from this point forward will be 10 years. Remainder of the differential is going to be attributable to a trademark, so that's going to be a intangible asset, which is going to have a 10-year life. In 2000X0S earned, so the subsidiary earned in Canadian dollars, $18,000, so that's basically the net income for the subsidiary. They had dividends for the subsidiary, $7,600, and the dividends paid exchange rate was Canadian dollars, 1 Canadian dollars to the 0.75 US dollars. And then on 1231X0, the direct exchange rate is Canadian dollars, 1 Canadian dollars to 0.64 US dollars. Average rate is going to be 1 Canadian dollar to 0.67 dollars. So it is determined that the Canadian dollar is S functional currency. So the functional currency for S we've determined then to be the Canadian dollar. So we're going to make a schedule to show the differential allocation and amortization for 2000X0. So let's start with our worksheet up top. We're going to start off with the investment cost. So the investment cost. Now I'm going to have Canadian, the exchange rate, and then the dollars. The investment that we put in place, we have in US dollars here, the 140,000. So I'm going to be picking up the 140,000, and then I'm going to pick up the exchange rate that happened at this point in time. The exchange rate at that point in time, 11X0, the point in time that the consolidation took place, is 0.81. So I'm going to take that exchange rate. Now that's going to be the 1 Canadian dollar to $0.81. So I'm going to divide then to back out here. I'm going to say this is going to be equal to the 140,000 divided by the 0.81, which is going to give us the Canadian dollars then, which we're going to say is the 172,840. Then we want the book value of the investment. So the book value of the investment, I'm going to put here. I'm going to paste it there, and that was given to us in Canadian dollars. So we had now the 94,000 Canadian dollars. And notice the difference in the dollars that we're using here. And the way you can differentiate the dollars is you can go to, if I want these Canadian dollars, you can go to the drop down. We go to the more and the currency. So if there's any change, and then you can change the currency here to whatever you would like. I'm going to just use the symbols that they give us for the currency, the 3 code symbol for the currency. And then the US dollar, I typically will just use the US dollar setting. So you might want to change these to basically dollars. I'll do that. It'll be in your worksheet as dollars. It'll usually add the decimals. So then if you remove the decimals, if they're not needed, then we'll just have the dollar sign. So dollar sign represents US dollar, CAD, the foreign currency, in this case, Canadian dollars. So then we're going to be picking up the second amount, which is going to be this 94,000 Canadian dollars. We'll multiply that times the same exchange rate, and we're going to say the Canadian dollars times that exchange rate of the 81 at that point in time. That's going to give us our totals. So let's go ahead and sum that up. That's going to give us our differential. Let's subtract them out, I should say. And that'll give us our differential. So here's the cost. We purchased 100%. We're not dealing with any non-controlling interest then at this point. So we're going to take the 172,840 minus the 94,000 on the Canadian side of things, and then the 140 minus the 76,140 on the US dollar side of things. And then we're going to break that out between the two components which we allocated the differential to, one being the fixed assets. So we said the fixed assets had a fair value that was greater by the 10,500 Canadian dollars. So I'm going to put that on the Canadian dollar side of things. 10,500. Once again, I'm going to take our rate and convert that over into the dollars. So 10,500 times that 0.81 is the 8,505. Then the difference, they said, wasn't goodwill. It was going to the trademark, which is going to be an intangible asset. That's what we said the rest of the differential was going to. So we're going to take that 78,840 minus the 10,500 to get that difference, that trademark amount in the dollars and in the Canadian or foreign currency. Okay, so now we're gonna have the differential allocation here. So I'm gonna take a look at this from an income statement perspective and then a balance sheet perspective. We're talking Canadian dollars on the left, US dollars on the right. We'll have the exchange in the middle. We're talking about the allocation of the differential now, which is the property or the plant and equipment and the trademark, meaning here's the differential, here's where we allocated it to between the property, plant, and equipment and the trademark. So now we're basically considering these items, right? We're considering these two items here. So I'm going to take a look at the income statement. Let's go income statement accounts. And we have the differential at the date of acquisition. The differential at the date of acquisition is this 10,500. And on the trademark, we had the 68,340. Now, we're going to use the exchange rate now to break this out. I'm going to say, okay, the exchange rate is 0.81, and that'll then give us the US dollars. I'm going to take the 10,005 times the 0.81, and then the trademark is going to be the 68,340 times the 0.81. That gives us the dollars. So we got the Canadian and the dollars. Notice that ties out to the way we have it over here as well. So then we're going to say we need the depreciation that's going to be calculated on it for the income statement side of things. We said the equipment has a 10-year life from this point, so we're just going to use a straight line method. I'm going to make it a negative number, so I'm going to say negative of this number divided by that 10 years. That's going to give us our 1,050 current year depreciation that we're going to add to it because of this differential. And then the trademark we said was 10 years as well, I believe. 10 years on the amortization, yeah. So I'm going to say negative of this number divided by, we're going to pick up the amortization, which is going to be that. So that's going to be the 6834. Then we're going to be picking up the rate. Now this is where it's a little bit tricky. Notice we've been picking up this rate up top. This rate has been as of the point that the consolidation took place. Now we're looking at an income statement account where we're talking about depreciation and amortization of the differential. So we use the average method on the income statement. This is where it gets a little kind of weird because, again, you might think, well, this is going to throw everything off. Yeah, it will. It's going to lead to this differential translation adjustment that we're going to have because we're using different rates. We had something that's in balance and we're going to translate it with different rates. But it makes sense to use this rate for the initial purchase, and then it makes sense to use the average rate for like the income statement because we're kind of picking the rate that makes the most sense, like the average rate over the time period that's covered. So the average rate we have down here is at 0.76. So if we multiply that out, we're going to say, all right, there's the 1,050 times the 0.76, and then we're going to be picking up the 6,834 times the 0.76, and there's our breakout there. So that will give us the remaining balance then on the balance sheet is going to be the sum of these two, remaining of the differential. It's going to subtract them. The sum will subtract them because one's a negative number. So we're going to sum these up. And I'm just going to do them one by one so you could see it. I'm not going to sum up the rates, obviously. That doesn't make any sense to sum the rates. So we'll sum these up, which is going to subtract them here. And the same here as well. Okay, so now we're going to consider on the balance sheet side of things. So I'm just going to say balance sheet side of things. We got the remaining balance translation at year-end rates. Remaining balance translation at year-end rates. I'm going to be picking up this 9450 and the 61506. So now we're looking at the balance sheet side of things, because this is basically the ending balance now of the differential that's still going to be included on the balance sheet, right? Which we're now going to have to convert the balance sheet items, and we typically use the balance sheet end of period dates to do that. So we typically use the balance sheet. So we typically use the 12/31 date, because now we're talking about the balance sheet. So we're going to use the end of the period, which is going to be the 0.64. And remember, we're talking about down here, determined that the Canadian dollar is the functional currency. So we're doing a translation here. So we're using that end date. So we're going to say, all right, so that means that this number, the 9,450 times the end date, the end point, the current date, balance sheet date, is going to be the 61506, and then we're going to use that 64 again. So now we're going to have this differential that's a result of this process, because now we use these different rates here. That's going to end up with this difference that happens. And that's going to be the difference between this item up top, the 7707, minus what we have at the ending balance with using this rate down below. We have a differential of 1,659, and then this differential is going to be the 50,161 minus the 39,364. Differential of the 10,798. So the total differential between the two is going to be that 12,457. So 12,457. Let's start to think about what P then is going to record on its books for the fully adjusted equity method for their investment then in S. So we're going to have our investments like we've seen in the past. We'll record our investments in S using basically the equity method, and then account for these items that we will have here. So typically we're going to say we have the investment in S, right? Investment in S and cash. So we're saying we paid cash straightforward because we just have the dollars here. We don't have any kind of funny business happening. So that's nice. That's going to be the 140,000, nothing unusual happening there. So I'm going to make this a little larger so we could see it. Next, we're going to pick up the net income number like we normally do, right? The investment goes up, and then the income in S goes up by the net income. And we know that S had net income of 18,000, but on their books, it's obviously 18,000 in Canadian dollars. So we're going to have to convert that over. Now, to convert it, we're going to use the average rate again. So we're going to use the average rate because we need to put it on our books. We're the parent now, which is in US dollars. So we got to convert that over, and we're going to use the average rate to do it because we're talking about income statement items, which are over a time period of time frame, a beginning to end type scenario. So we're going to say, all right, the investment is going to go up, and then the other side is going to be income from the subsidiary. This is going to be equal to, we're going to be picking up the net income that they had, the 18,000, multiplying that times the average rate for the period covered by the income statement, which we're saying is 0.76. 0.76, $1 Canadian, 0.76 dollars. That's going to be our 13,680 on the debit and on the credit. Next thing we typically have is the dividends, right? We have the dividends that we're going to record. We typically get cash. We're the parent company from the subsidiary. So we'll record the cash side, but we're not going to get exactly cash. What we're going to get then is Canadian dollars. So we're going to record those as Canadian dollars that we have. So instead of cash, we're Canadian dollars like an asset. It's just like if we had stocks or something like that, we're recording the units of Canadian dollars that we're holding on to that we will then value in terms of the US dollar. And then the other side, the investment in S, is going to be the other side. Calculating this, we're going to say, all right, the dividends went out. How many dividends? Where those dividends are here. They paid 7,600 in dividends. They all went to us because we're the parent. I'm assuming we're the parent company. We own 100% of the subsidiary. Therefore, all the dividends went to us, but they're in Canadian dollars. And then we're going to value the dividends when they went out at the point in time that they went out, because we can just pick the date that the dividends went out. So the dividend exchange rate when the dividends actually were paid was this 75%. So that's the rate we're going to use for the dividends. So we're going to be picking up the 7,600 on the Canadian dollars. We're going to convert that using that 0.75, the date at the point in time that the dividends went out. And that's going to give us our 5,007 on the debit and on the credit. Next, let's pick up our differential adjustments to the income statement. So we have these two items, one being property, plant, or the plant and equipment, and then the trademark, which are items that are going to have an income statement effect because of the depreciation and the amortization, which we calculated here. And those are going to be things that we're going to have to adjust for within our fully adjusted equity method, as we've seen in the past. So we're going to say, all right, then we're going to do that. The key here is that we've calculated in terms of dollars. So we've did the calculation in terms of Canadian dollars. We converted it to dollars, and we used the rate here, which is going to be the average rate to do so. So now that we have these numbers in dollars, we can record it on our side for our investment in S in the US dollars, what we need to conform to our reporting standards. So we're going to say, all right, then I'm going to do this separately. So each of them separately, the depreciation, and then I'll do the similar transaction for the amortization. You could combine them together if you would like. I would rather break them out because it's easier for me to look at and see where they're coming from. So we're going to say there's the 798, the depreciation, and that's on the property, plant, and equipment. So basically we're reducing our income from S in our as we report the equity method on our books for the parent company. Then the investment's going to go down. We're going to do the same thing then for the amortization as well, which is just going to simply be this calculation of the 5,194 that we did in our nice little table over there. Then we're going to have this adjustment. This adjustment down below from these different rates that we used is going to result in this adjustment, which we calculated total to be that 12,457. So I will combine these together for the total of the 12,457, but I'll use a formula to do so you can see it. If you're using this worksheet, you can see exactly where it's coming from. We're going to say this will equal, and we'll sum this up. There it is, breaking that out. And that's the other comprehensive income translation adjustment. That's going to be the debit and the credit that we'll have here. Now we're going to fill out a little table here for the proof of the translation, and we'll have another adjustment with regards to it. So let's do that down below. We're going to say, all right, let's do this. We're going to say, starting with the net assets at the beginning of the year. So we're going to be picking up the net assets of the beginning of the year. We're basically going to be doing a similar kind of thing that we did with this table over here. We got the Canadian dollars. We're going to have to figure the correct exchange rates that need to be used and then bring this out to the US dollars. Different exchange rates being used will result in a change or an adjustment that will need to be made. So we'll have a translation adjustment as a result to that. So we're going to say the net assets. So we were given this, but we were given it in Canadian dollars once again. That was at 94,000, the net assets at the point in time that the purchase took place. So I'm going to pick up these Canadian dollars once again at the 94,000. We're going to use the exchange rate at that point in time. At the point in time the purchase took place of the securities, that being the 0.81. Then we'll multiply that out. That's going to be the 94,000 times the 0.81. And so that's going to give us then the dollars. And I'm going to make these dollars over here. Let's make these just so we can see a dollar sign. I'll move. It'll be this way for you already. I'll remove that. And so there we go. Okay, so then we're going to have the adjustment for changes in net position. Adjustment for changes in the net position. I'm going to say, we're going to put that there. And then we've got the net income. So the net income, put here. Going to indent it, and once again we have the net income, which was at 18,000 for the Canadian company, but it was in Canadian dollars. So we're going to pick that up and then convert it. So we'll pick that up on our Canadian side of things. The Canadian dollars are the 18,000. We're going to convert it, but this time we're using the average rate because we're talking about the income statement now. So we want to use the average rate there. Multiplying this out, we're going to be picking up the 18,000 times the average rate, that being the 13,680. Then we've got the dividends, so we'll pick up the dividends now. I'm going to put out the dividends down below. Picking that up, this is going to be our other adjustment. Now, once again, the dividends, as we saw before, are in the Canadian dollars. We're going to use the conversion rate there being the date at the point in time that the dividends were paid, that being 0.75. If we multiply that out, we've got the 7,600 times the 0.75. Next item here is going to be the net asset translated at rates in effect for those items. This is going to be for the outer column, so I'm going to put this in the outer column. I'm going to put it down here in 027. I'm summing up then the US dollar column. So I'm going to be summing this up equals the sum. It's going to subtract out for this item. Notice we made this one negative once again. So I just put a negative sign. So obviously this plus this minus the 5,007 is the 84,120. And then we're going to say net assets at year end. I'm going to give us the net assets at the year end. And this time I'm going to sum up. Let's sum up this column equals the sum of these items. And then we're going to take a look at the translation rate at year end, which is going to be the 0.64. That's as of the balance sheet date at the end of the time period. So now we're going to multiply this out. We're going to say, all right, there's the 104,400. If we multiply that all times the 0.64, the one rate here versus the multiple rates we used up top, we're going to have our adjustment again. And we're going to call that then, what are we going to call that? We're going to call that a translation adjustment. So that's going to be a change in other comprehensive income. And that's going to be our translation adjustment. So I'm going to subtract this out. We're going to say this is going to be the 84,120 minus the 66,116. That's going to give us our adjustment. That's going to be 17,304. We're going to have then a debit that's going to have to go to the other comprehensive income. Other comprehensive income of that 17,304. Other side going to the investment in S. Investment in S is going to be the credit, of course, of the 17,304. And again, you can kind of just look at this worksheet and kind of mold this worksheet over. Obviously, we're basically coming to this difference by saying, hey, look, this is the net asset translated at the rates in effect, meaning we're going to have the beginning balance here. We've got the adjustments that took into account the different rates that were accounted for them. And then we're going to compare that to the net assets at year end, which are basically the balance sheet accounts, which we typically use for the balance sheet accounts, the one rate at the end of the time period, 0.64. And so the difference between them, of course, is that adjustment that we're going to need in order to balance out that 17,304.